Thank you. I can see people joining. We will start the session shortly. Good morning, good afternoon, good evening, tax fans, depending on where you are located. And welcome to the second session of our Global Indirect Taxes event series. Today, we will host an interactive virtual session, and we're not alone. I'm happy to share with you that many people from all over the world have registered for today's event. This series of events will help you and your organization navigate the significant changes that have been made to indirect taxes globally and provide an overview of technical and commercial considerations across all key jurisdictions. The webinars will also cover cross-border services, the concept of an establishment from a VAT and indirect tax perspective, and customs duties. Please take a few minutes to read through the disclaimer for this event. We truly look forward to all your questions and comments. You can do so by using the Q&A box on your toolbar at the bottom of your screen. Even if you cannot see the questions, the host can see them. Due to time restrictions, our presenters will do their best to respond to all questions received during the event. We will also conduct a short survey at the end of the event, which will be anonymous, by the way. We would appreciate your honest feedback, as this enables us to improve our virtual event offering to you. The survey will automatically pop up on your screen after the session ended and will take less than 2 minutes to complete. By way of introduction, my name is Stefan de Keulaar. I'm PKF International's Tax Director based in Belgium, and I'm joined throughout the series by Luigi Lungarella, who leads PKF International's Indirect Tax Pillar and who is also a member of the International Tax Committee. Without any further ado, I will give the stage to our first presenter, Luigi Lungarella.
Thank you. Thank you very much, Stefan. And a big thank you to the rest of the PKF International Indirect Taxes Group. And I happen to be one of the founding members of the group, and I'm very proud to be leading a team of remarkable practitioners located in around 480 offices in over 150 countries. And this series of events sees a number of members of our indirect taxes team providing you with the tips that you can adopt within your own organization. So for example, during the Global Indirect Tax Update that we held on the 6th of October, I was joined by Ralph Rudenberg from New York, Gennady Timonichev from Moscow, and Fan Abdul Wahab from London. And by the way, if you haven't done so, you can actually watch the recording of that on pkf.com. And today we will be building up on our global approach by involving authoritative practitioners from both Amsterdam and Paris. And as PKF International Indirect Taxes Group, we meet regularly both in person and through our online monthly meetings that we're carrying out to ensure that our clients can manage risk with confidence and to ensure that they can do so with as little disruption as possible. And since VAT is a tax based on common European legislation, which is frequently translated and understood with no consistency, we as VAT advisors and our client base have benefited hugely from our regular communication. And we're able to identify unique opportunities for our clients, and we're able to minimize as far as possible exposures and maximize opportunities for the international businesses that we act for. And businesses trading internationally, in particular within Europe, and especially in e-commerce, have real problems in relation to VAT. But any business involved in e-commerce should not solely focus on European VAT matters, but also on considerations affecting VAT in non-European jurisdictions, as well as alternative indirect taxes such as GST and sales taxes across the world. And this is because indirect taxes globally are seen by governments as a relatively stable source of tax revenue. And we also need to bear in mind that there is an increase in development of e-commerce measures, which are being proposed at OECD level and adopted nationally to ensure that indirect taxes are collected efficiently and with no leakage or whatsoever. And this has led to a number of draconian changes, such as developments in the United States following the Wayfair decision on remote sales tax collection, and more recently, the United Kingdom, Canada, and the European Union utilizing platforms as tax collectors almost. And businesses involved in e-commerce must be well aware of these changes and how their implementation will impact business structures and will impact contractual terms, including pricing, including logistics, and including, of course, systems. And since this is such a key area to focus on at the moment, due to the increasing number of changes, both regionally and nationally, we as PKF, we are investing great resources in indirect tax services for this sector. And we're very well placed to be able to respond to requests from businesses involved in e-commerce and to proactively meet client needs. And this is why we have two sessions dedicated to e-commerce. The first one, this one, will focus on the flow of goods. And the second session, which will take place in February, on services and how more and more countries are trying to ensure that remotely provided services are taxed where they are consumed. And this is because very often exposure to indirect taxes ends up where the recipient is based as opposed to where the supplier is located, which obviously means that a global approach is often required. And as members of the PKF International Indirect Taxes Group, which of course include Ibrahim, includes Stephen, includes Ralph, Gennady, Fan, myself, and many other indirect tax practitioners throughout the countries represented by the network, we work jointly with a number of common organizations involved in e-commerce. And what we want to do with our time today is to provide you with some background as to how we work closely, regularly sharing knowledge and analyzing how non-EU businesses could now save time and administration when selling to EU consumers. And all of this with a view to minimize as far as possible any indirect tax exposure for your organization and to provide you with the tools required to identify additional opportunities. But so I mentioned Stephen Dell from Helios in Paris beforehand. Stephen is an authority in the world of VAT. He lectures at 3 French universities on indirect taxation, and he's also the president of the International VAT Association, and also a member of the EU Commission's VAT expert group, and a member of the OECD Technical Advisory Group on Consumption Taxes. We will also involve Ibrahim Hamed, VAT manager at PKF Wallust in the Netherlands. And Ibrahim regularly writes articles on VAT and e-commerce. He lectures on turnover tax at the University of Amsterdam and is also a member of several bodies, including the Dutch Association of Tax Advisors. And both Stephen and Ibrahim are also authors of VAT in the EU, which is an influential country-by-country guide covering all 27 member states and the UK, which has recently been published by Tollis LexisNexis. And one of the topics covered in quite some detail within this publication is the new rules for the one-stop shop and electronic marketplaces, which have been introduced by the EU with effect from the 1st of July 2021. And the publication also covers the greatest majority of the topics that we're going to be illustrating later on today, including also the import one-stop shop and the non-union OSS scheme, as well as changes from other non-EU jurisdictions such as the UK. But what it does not cover is some real gems that Stephen Dell is about to share with us, some extremely fresh, deriving from the Fiscalis meeting earlier on this month, and some hot off the press updates from the European Commission relating to the interaction between VAT groups, the new provisions on e-commerce and the USS scheme. But beforehand, it is probably best to take a little step back and consider why indirect taxes are being deployed to e-commerce.
Thank you, Luigi. Good morning, good afternoon, good evening to everybody. Why is actually quite, I think, a simple question. There's clearly a significant amount of indirect tax revenue which is being lost to governments, both within and outside the European Union, as a result of the rapid expansion of e-commerce globally. Just one example. The EU estimated that before the abolition of the €22 de minimis threshold, which took effect, as Luigi indicated, from July 1, the EU collectively was losing something in the order of €5 billion of VAT just by virtue of the fact that goods below that €22 threshold were not being subject to import VAT when imported into the European Union. This, of course, creates distortions of competition with domestic suppliers. Those within the European Union have to charge VAT from the first euro, euro of turnover. And other tax solutions that countries have been looking at to try and apply some form of taxation to the e-commerce sector have not been that effective. We can think about some of the digital services taxes that have been introduced. We can think about the taxes they've been imposed on delivery charges. Some of these have had some limited effect, but nothing of the scale of applying VAT across the board to the first euro of goods being supplied into the European Union. And of course, that has an effect on employment in the countries in which consumption takes place, because if there's no tax revenue being generated, then governments will obviously not be able to employ people. And just generally, it's a loss of employment in the domestic retail sectors. But it's the scale of the increase of the global EU marketplace that is focusing government's attention. This slide, I think, shows or demonstrates this very clearly. If we go back to 2014, and this is in number of parcels, 43 billion parcels in 2014. 131 billion, so 3 times as many parcels delivered globally, cross-border in 2020. Now, there's clearly a pandemic effect that has an impact there, but it's not just due to the pandemic. Businesses globally are operating on a global basis, exploiting, if you like, economies of scale by delivering the similar products on a global basis to countries all around the world. So there's a clear trend, therefore, of collection mechanisms, which the governments have been looking at to ensure that with this globalization of e-commerce, that these tax revenues, essentially indirect tax, are still going to be collected as appropriate into the member states in which, or the countries in which the consumption takes place. We're talking about goods, but we should remember, of course, that a significant range of measures were adopted progressively since the Ottawa Conference in the end of the 1990s to introduce mechanisms by which VAT could be applied or applied to cross-border supplies of services, digital services. We'll talk more about that in our seminar in February. And since the focus has moved to a large extent from the taxation of services cross-border to the importation of low-value goods, governments are looking across different measures that are possibly adapted or adaptable to ensure that VAT is collected on the importation of low-value goods. So what kinds of collection mechanisms by platforms are currently under consideration globally? Well, this is a presentation from the OECD. and reflects the over 20 years of work since the Ottawa conference, looking at what role the platforms can play in the collection, as Luigi indicated, of VAT, GST on goods being shipped, delivered on a global basis. And this ranges really from the platforms having a very much an educative role, explaining to suppliers what they need to do to be compliant with their tax obligations, indirect tax obligations in those countries in which their products are being delivered into. Should it be more around platforms just sharing information with tax administrations as to transactions being undertaken through their platforms, facilitated by the platforms on behalf of the underlying suppliers? That information being shared globally, how is that going to be done? On what basis? What methods? What models? Push models? Pull models? There's lots of discussions going on a global basis. And if we think just at an EU level, with the introduction of the DAC 7 directive with effect from the 1st of January of 2023, there will be far, far more information being shared around what platforms are facilitating in the near future. Should platforms become jointly and severally liable for the tax, the VAT, the GST that's not been collected by the underlying suppliers? Or should, as Luigi indicated, should the model rather not be making the platforms, because they have the interface with the final consumer, should the platforms themselves not be held solely responsible, solely liable for VAT on transactions with final consumers? I think the jury's out on that one. We'll come back to that question at a later point in our webinar this afternoon. But what's the OECD actually doing to help countries collect indirect taxes in the e-commerce world? OECD is helping countries build capacity. It's helping countries exchange information in relation to VAT. And that's linked, as I mentioned, to other proposals, other dispositions being implemented, both in the direct and the indirect tax spheres, to ensure greater exchanges of information globally between tax administrations in relation to operations or transactions facilitated by operators. And of course, technology. So with greater use of technology, will tax administrations not be requiring businesses to report real time on the transactions that they're undertaking? So again, the administrations can make sure that tax is collected at the right place, at the right time, and also from the right person. The OECD is rolling this out through a series of toolkits and providing resources to those countries which need help in implementing VAT strategies, VAT policies in order to tax effectively digital trade. Providing legal basis, building on what's been done in other countries and that's worked successfully, helping countries develop effective collection mechanisms, leveraging the power of the digital platforms to enhance VAT collection, and through administrative cooperation, driving risk management techniques and technologies to identify where the leakages might arise and what measures can be taken to stop those leakages arising. So as advisors, we're fully up to speed with what's going on globally. With these global trends, to ensure that we provide you, our clients, running global businesses with our global advice. Luigi.
Oh, that was quite a fascinating overview, and it is obvious that the rapid and radical changes that we have seen over the past few months are likely to be amended further in due course. And this is not solely linked to VAT and VAT only. So, for example, the UK government 1 month ago announced that it is considering an online sales tax and also a delivery tax. But taking a little step back to the present and in relation to the new rules for the one-stop shop and electronic marketplaces, which have been introduced by the EU with effect from the 1st of July 2021, we need to bear in mind that they do not affect only EU businesses, but businesses from throughout the world. And there have been some adjustments along the way. So, for example, although they came into force 5 months ago today, they were supposed to be introduced from the 1st of January, therefore 11 months ago today. But the EU Commission decided to delay its implementation until the 1st of July due to the pandemic. And the new rules are supposed to make life simpler, but they do not. They do not at all. And Ibrahim will provide you with a number of examples outlining some of the complexities that we have encountered with our client base. One of the big features of the new rules was introduced in the UK with effect from the 1st of January 2021, making digital marketplaces such as, for example, Amazon, liable for output tax on some consumer supplies by deeming the marketplace as part of the supply chain rather than just acting as a facilitator. And that is just one of the changes that the EU brought in. And probably the most significant one is the introduction of the one-stop shop that is obviously related to the mini one-stop shop that has allowed suppliers of B2C digital services to register in one member state and to account for tax or for output tax in all the member states where the consumers belong, and to do so within just one single return rather than having to register in all the member states where they have customers. So the principles of the mini one-stop shop have been extended to include more supplies than just broadcasting, telecommunication, electronic services, and in practice extending the idea to distant sales of goods to consumers, where up till 5 months ago and one day, traders would have had to register for VAT in the destination country to account for that country's output tax. So they have also included other B2C services, not just the digital ones, where the place of supply is the customer's country. Now, bear in mind that a one-stop shop registration is separate from a normal registration, and it is therefore possible to have one of each. So B2B supplies would go in the normal registration, and B2C supplies on the OSS. But Ibrahim can certainly shed some further light on the intricacies of the scheme through a number of practical examples and some clarifications on common issues that we have encountered within our client base.
Thank you, Luigi. Good morning, good afternoon, and good evening, everybody. From an EU focus, I'll be zooming into the recent changes with a couple of case studies that entered into force on the 1st of July this year. More specifically, in relation to the Union One-Stop Shop scheme and the Import One-Stop Shop scheme, both respectively known as the OSS and the IOSS. Before discussing both schemes, I would like to start with a polling question as a warming up for the next slides. Bear in mind that you will have 25 seconds to respond. But first, I will set the scene and read the question. Given the available time for my slot, I will be only able to respond briefly to the correct answer. From the 1st of July this year, a number of amendments to the VAT directive have entered into force. With the new rules in place, EU businesses are placed on equal footing with non-EU businesses. Here comes the question. One of the changes relates to the Union OSS scheme. Which of the following answers is correct? The OSS scheme can, among others, be used by a taxable person established in the EU who is not a deemed supplier to declare and pay VAT for A, intra-community distance sales of goods, B, certain intra-community B2C supplies of services, C, all intra-community B2C supplies of services, D, intra-community distance sale of goods and certain intra-community B2C supplies of services, or E, intra-community distance sale of goods and all intra-community B2C supplies of services. The 25 seconds starts now. I see the responses coming in. Very good. Almost time. Couple of seconds more, and I think we can stop the time and share the results. I see that the majority has chosen D. However, the correct answer is E. Before the 1st of July this year, the Union OSS could only be applied for so-called TBE services. What is an abbreviation for telecommunication, broadcasting, and electronically supplied services. Given the success of the mini one-stop shop, which was the old scheme, the Union OSS is broadened for all cross-border supplies of services to non-taxable persons. Examples of B2C supplies of services are services connected to immobile property or transport services. In addition to the B2C supplies of services, the scheme also covers all intra-community distribution of goods by either a supplier, a business, or a deemed supplier, an electronic interface such as the Amazons of this world. In short, the Union OSS scheme ensures an effective and efficient collection of VAT, while at the same time, the administrative burden for suppliers is reduced. In this slide, I have set out two business cases, which demonstrates the applicability of the Union OSS scheme relatively simple. Prior to the 1st of July of this year, businesses active in the e-commerce had to keep track of all their sales made for each member state. Based on the former place of supply rules, the place of supply was in principle deemed to be the place where the goods are located when the dispatch or transport of the goods to the consumers begins, which would usually be the place where the supplier is established. However, when the applicable threshold of a member state was exceeded, varying from 35,000 euros to 100,000 euros, the business had to charge local VAT of its customer, in line with the taxation at destination principle. Looking to case study 1, business Y would in principle charge Dutch VAT to its Belgian customers for its distance sale. If the threshold of 35,000 euros for Belgium was not exceeded. This would be different if business Y requested the Dutch tax authorities to opt its sales to be subject to Belgian VAT, or when the business would exceed the just mentioned threshold. The abolition of the old annual threshold has been replaced with a new EU-wide threshold of 10,000 euros, together with the place of supply rules, which is in line with the taxation at destination principle. You can imagine the administrative burden that comes with this replacement for businesses. An EU-wide active business would in potential need to register itself for VAT purposes in all of the 26 member states. To ease the administrative burden, businesses can choose to use the Union OSS scheme in their member state of identification, where they are established. Bear in mind that the use of the Union OSS scheme is optional and can only be used for member states where the business is not registered for VAT purposes, due to, for example, the transfer of own goods or local supplies to non-taxable persons from a warehouse. For the latter supplies, the administrative burden unfortunately remains. Looking to the case studies, the outcome is relatively simple. For the distance sales below the threshold of 10,000 euros, business Y will have to charge its customers Dutch VAT at the applicable rate. For sales above the threshold, foreign VAT must be charged of each member state where the goods are located at the time where their dispatch or transport ends. In this case, German VAT, French VAT, and Spanish VAT. Bear in mind that it could well be that a non-taxable person resides in member state A, but places an order to have it shipped to member state B. As for the place of supply rules, member state B as the ship to address must be taken into account for VAT purposes. As stated in the polling question, new is that all B2C supplies of services can be reported under the Union OSS scheme. The difference with the non-Union OSS scheme is that the latter can only apply for B2C supplies of services and not the intra-community distribution of goods. In theory, this means that the non-EU established business may need to file two OSS returns. One under the non-Union OSS scheme for B2C supplies of services, and another under the Union OSS scheme for its intra-community distribution of goods. Bear in mind that foreign input tax cannot be deducted in the OSS return. With no VAT registration in a specific member state, the business, depending on its place of establishment, must either submit an 8th or 13th directive refund request. things will get more interesting in case study 3. Here we have a business who holds a stock of goods in its warehouse in Germany. On a regular basis, the business sells goods to non-taxable persons in Belgium. The question here arises whether business Y can report the disposal of goods under the Union OSS scheme if opted for this. According to the explanatory notes, business Y can indeed do so. However, it is required that business Y does not have a VAT registration in Germany. Otherwise, the business Y would be required to register itself for VAT purposes in Belgium in order to meet its reporting obligations there. It could further also be that business Y has disposal to non-taxable persons in the Netherlands. Even though the Netherlands is the member states of identification of Mrs. Y, the intra-community disposal of goods from Germany to the Netherlands are to be declared in its OSS return, if opted for this. They may not be included in its domestic Dutch VAT return. You may ask yourself if drop shipping of non-important goods is covered by the Union OSS scheme. This is the concept of selling products online without owning a physical inventory. To my understanding, the answer to this question is not clear-cut. In Belgium, for instance, this is not the case in the event the supplier arranges the transport or dispatch of the goods. The supply itself must then be qualified as a triangulation supply, whereby the first supply will be qualified as an intra-community supply from the member state of the supplier to the member state of the non-taxable person, followed by a domestic supply in the latter member state. For the dropshipper, this would trigger a VAT registration and accompanying compliance burden in the member state of the non-taxable person. Perhaps Stephen Dale could explain this in more detail or share the European Commission's vision on that point.
Ibrahim, thanks very much. I think the first difficulty with this issue of drop shipping is one of definition. Depending upon the business model, as you've indicated, who owns the goods in the country of departure, are they bought from third party, are they wholly within the European Union, do they come from outside the European Union? The Commission is aware of the issue, and it's one of the points that is being addressed as part of the VAT in the Digital Age project, which we will report on, or the final report rather, should be published sometime towards the end of, towards the middle of January. Anyway, let me pass over to Luigi to take us through IOSS.
Grazie. Grazie, Stephen. And it is obvious that the one-stop shop is certainly a complex area, even without the added complexity of drop shipping. And the one-stop shop is also an area that affects a great number of e-commerce businesses. And then on top of that, we also have the import one-stop shop scheme, which is a completely new arrangement that allows suppliers and dim suppliers to account for output tax on those small consignments coming from outside the EU and being supplied to EU consumers. An interesting point that we need to consider in relation to this is that it will be used by both EU and non-EU suppliers and dim suppliers. And once again, Ibrahim will be able to share some practical examples that we have encountered within our client base. And you have another polling question, Ibrahim, is that right?
That's correct. Thank you, Luigi. Now we have discussed the Union OSS scheme. Let's move on to the second polling question. Again, you will have 25 seconds to respond, but let me start with setting the scene. The import one-stop shop scheme is an optional scheme which can be applied by both EU and non-EU established businesses, covering disposal of goods with their intrinsic value not exceeding 150 euros from a third territory to a customer in the EU. Here comes the question. How can the intrinsic value for commercial goods be best defined? This is the price of the goods themselves when sold for export to the customer territory of the EU. A, excluding transport costs. B, excluding transport and insurance costs. C, excluding transport and insurance costs and any other taxes and charges. Or D, excluding transport and insurance costs and any other taxes and charges insofar as separately indicated on the invoice. Time starts now. I do not see any responses coming in. A couple of more seconds. I think we can stop the time and share the results. And something apparently went wrong here.
I believe we had a slight technical issue with that. But yeah, go ahead, Ibrahim, and provide us with the correct outcome.
Yeah, sure. The correct answer is D, and I can be brief about this. Goods with a value not exceeding 150 euros are qualified as a low value goods. From a customs perspective, these goods are qualified as free of import duties. The amount itself is relevant for the applicability of the IOSS. Bear in mind that excise products are excluded from the IOSS scheme, such as alcohol products, perfumes, and tobacco. As pointed out earlier, with the new rules, non-established businesses are placed, non-EU businesses are placed on equal footing with EU businesses, which prior to the 1st of July this year did not have to charge VAT for distance sales from outside the EU. There was also no import VAT involved for small consignments with an intrinsic value up to 10 or 22 euros. With the change of the place of supply rules to the place where the dispatch or transport of the goods ends, and secondly, the abolition of the VAT exemption for small consignments, there will be two VAT taxable events. The first VAT taxable event is related to the distance sale, and the second VAT taxable event is related to the importation of goods in the EU. With the IOSS scheme, the second VAT taxable event will be exempt. In other words, the importation of goods will be VAT exempt. However, this only applies if the intrinsic value of the consignment does not exceed 150 euros. The scheme itself is optional, just like the union and the non-union OSS scheme. To be able to opt for the IOSS scheme as a non-EU business, which can choose any member state the application of the scheme, an intermediary must be appointed. This only differs if the EU has concluded a VAT mutual assistance agreement with a specific country, which only is with Norway for now. This means that practically every non-EU taxable person must appoint an intermediary for the use of the IOSS scheme. The intermediary itself must be a taxable person established in the EU. He also has to fulfill all the obligations laid down in the IOSS scheme for the supplier that appointed him, including the submission of the IOSS return and payment of VAT on the distance sales. However, the supplier who appointed the intermediary remains liable for the VAT obligations, including the payment of VAT together with the intermediary. In practice, member states will attempt to recover the VAT from the intermediary, and if this fails, member states can try to recover the VAT from the supplier. Once appointed, an identification number will be assigned to the intermediary for the use of the scheme by the non-EU business. In practice, the appointment of an intermediary can be quite challenging. Before moving on to the case study, I would like to point out foreign input tax cannot be deducted in the IOSS return. With no VAT registration in a specific member state, the non-EU business must submit a 13th directive refund request in a member state where it has incurred input tax. Okay, now let's move on to the case studies, where I will be zooming in on non-EU business having distance sales to non-taxable persons in the EU. Looking to both case studies, we see that the non-EU business having distance sale of goods to the Netherlands, Spain, and France, with the import taking place in the Netherlands. Assuming that the intrinsic value of the consignment does not exceed 150 euros, together with the appointment of an intermediary by the US business, the import will be VAT exempt. Based on the place of supply rules, the US business will need to charge Dutch, Spanish, and French VAT on its sales to the non-taxable persons, respectively. The transactions will be reported in an IOSS return, whereby the collected VAT will be remitted to the tax administration in the Netherlands, who on its turn will transfer the Spanish and French VAT to the latter tax authorities. The IOSS, just like the OSS, is a complex area, but affects an area of our clients. But there is another scheme available, and that will affect mainly non-EU businesses. Over to you, Luigi, since you are now out of the European Union.
Yes, a list for VAT purposes have now been located outside of the EU for 11 months precisely, and it's been a very interesting 11 months, I have to say. And it's also been very interesting because we now have the non-union one-stop shop, which is available to a supplier that has no establishment in the EU. So due to the changes resulting from Brexit, it is therefore a possibility that a British business that has no establishment in Europe will need, of course, to adopt it. Now, remember that a stock of goods is not necessarily an establishment, but usually it makes you registrable for VAT, which means that you can use the non-union one-stop shop to account for output tax on B2C services, even if you're registered for supplies of goods because you have goods in Europe. What is not on the list is accountancy, legal, consultancy services, etc. They're chargeable in the member state where they have been received if the member state where the recipient is based has introduced a use and enjoyment rule for that particular service. But this is something that we're going to be discussing during our session on the 2nd of February. So as you can tell, these changes are hardly a simplification, and although there has been generally what I would call a smooth transition from a VAT clearance perspective, there have been some teething problems as well. Is that the case, Stephen?
Yeah, thanks, Vici. So as you say, we're now 5 months on from the 1st of July 2021, when the broader, should we say, the full one-stop shop, union one-stop shop scheme, the non-union one-stop shop scheme, the import one-stop shop scheme were introduced. So whilst, as a general, I think, comment, we can say that they've all worked well. The Commission in particular is very satisfied with the way that both businesses and member states administrations, whether it's customs or tax administrations, have adapted to the new rules. The Commission's initial kind of view is that yes, we are perhaps where we expected to be. That having been said, there are still nonetheless 3 member states who, as at the end of last week, had not yet transposed into their domestic legislation the provisions of the VAT directive, which took effect on the 1st of July, and the Commission has launched infraction proceedings against those 3 member states for non-compliance with European Union rules. There have been complaints about the customs authorities examining in detail packages which should have come in under the, or did come in under the import one-stop shop provisions, and therefore should not have had or given rise to any particular kind of checks, at least as regards the values, any tax compliance. But nonetheless, apparently, customs are looking for packages which are undervalued, which apparently is still occurring in the import one-stop shop environment. Ibrahim mentioned, of course, that you can use that regime if the value of the goods import intrinsic value does not exceed 150 euros. And apparently some businesses are trying to bring goods into the European Union with an intrinsic value greater than that amount under the import one-stop shop regime. Initial statistics that the Commission has indicated, about 7,000 to 8,000 IOSS registration, when in fact the actual number the Commission was able to establish was 7,379 import one-stop shop registration introduced with effect on the 1st of July, that with effect on the 5th of November. 80 to 70 or 70 to 80,000 union one-stop shop, non-union one-stop shop registrations for B2C services. 710 million euros of VAT accounted for through import one-stop shop, which should broadly account to 3 billion euros in a full year. Interestingly, though, statistic is that the average package value introduced under the import one-stop shop with effect from the 1st of July is actually less than 7 euros. And 50% of the VAT on the goods relates to goods of less than 22 euros in value. 94% by volume of imported goods are declared by the import one-stop shop. So there's clearly significant progress being made in this 5-month period, but there are issues. There are problems with alignment of the tax and customs regulations. there was a large meeting between member states, customs authorities and tax authorities in the middle of last month to identify some of these issues and try and find practical, workable solutions to deal with these mismatches. In particular, around the potential conflict as to responsibility between the VAT implementing regulation and the Union Customs Code's provisions. The question is who's liable for errors, mistakes being made in relation to imported or declared goods. Issues around return goods, so goods being sent back by the customers, the refund mechanisms of any VAT charged on goods that are eventually returned to the non-established or to third country, third territory, departure point. Apparently, the refund mechanisms are not still working terribly well. There is, in the Vast and Digital Age project, some further options being examined to see what whether we can make the import one-stop shop system more effective. Essentially two. First one is to remove this €150 threshold, the one that Ibrahim brilliantly outlined. But also there's a second range of options around the making of the import one-stop mandatory. So to the extent any business, if you like, making supplies of goods to non-VAT registered, non-taxable persons in the European Union, where those goods do not have an intrinsic value greater than €150, one of the proposals the Commission is looking at is to see whether it not makes sense to make the use of the import one-stop system mandatory, or perhaps a slight variant to introduce a threshold below which you would have a choice, if you like, as to whether, above which rather, you would have to use the import one-stop shop. Below that threshold, the import one-stop shop regime would not be compulsory. But it's not all done yet, and there's lots of issues still to be addressed. eCommerce have produced a short video to illustrate one very important issue, which is likely to slow down the development of e-commerce within the European Union, and that is the movement of goods between distribution locations.
The VAT One-Stop Shop 2.0, towards a unified VAT solution. The introduction of the European Union's 2021 e-commerce VAT package has helped by simplifying VAT obligations for businesses distance selling across the EU. But this leaves out an important aspect of EU trade. Businesses don't only store their inventory in their own countries, but also in various EU countries where they aren't established. And they have to comply with VAT obligations in each one of them. A system that puts small and medium-sized enterprises at a disadvantage. Take Alice. She wants to sell to customers all over Europe. To offer a fast, efficient, and eco-friendly delivery, Alice needs the flexibility to place her inventory in multiple locations across the EU before selling to her customers. But for each of these countries, she has to apply for a VAT number and file VAT returns. This is time-consuming and costly. It takes Alice more than 100 days and thousands of euros to get just one VAT number. Once that is set up, she needs to file VAT returns, costing €8,000 every year for every EU country of storage, which makes the idea of cross-border storage less and less attractive for Alice. Policy action is necessary to protect businesses from this situation. The single market needs an extension of the VAT one-stop shop to a version 2.0, allowing SMEs like Alice's to report all EU supplies and inventory movements through a single VAT return. This will simplify VAT compliance and reduce costs, allowing SMEs, the backbone of Europe's economy, to expand and grow. Moreover, consumers all over Europe will have a larger choice, better prices, as well as a faster delivery, and EU countries will benefit from more trade and better VAT compliance, providing additional tax revenues to fund public services. And this is why the EU needs a VAT One-Stop Shop 2.0. Simpler, fairer, more efficient.
So it's clear this is a very important issue for small, medium-sized businesses, to help the development of e-commerce across or within the European Union. One perhaps approach that's being examined, and again, it's just one approach amongst many which the Commission is currently looking at to deal with the particular issue raised by e-commerce, is to see whether we can't bring within the scope of the one-stop shop provisions these movements of goods without change of ownership when the goods are transferred across internal boundaries. In addition to that, the Commission is looking to see whether it wouldn't make sense to expand the notion of deemed supplier that Ibrahim has brilliantly outlined earlier in relation to goods being imported from third countries, third territories, to see whether in fact it would not make sense to have that as a rule rather than exception. So where an intermediary platform facilitated a transaction in goods within the European Union, the platform would always be deemed to be the supplier of those goods to the final consumer rather than the underlying supplier himself. This, of course, has downsides. In particular, if we extend that deemed supplier provisions to services into the tour operators margin scheme, in relation to goods, second-hand goods, it will impact, of course, in different ways depending on the different business models adopted by the platforms. And there's clearly a whole range of views as to what approach is the right one to be adopted, and there may well not be a one answer or one reply fits all situations. There clearly also needs to be a respect of the concept of proportionality. Is it reasonable to make platforms always liable for the VAT on all underlying transactions, even those which can arise they may not be aware of? And there's an issue around also the change in place of supply rules. If you have an intermediary, what's the place of the supply, the underlying transaction? Is it the place where the underlying supplier is located? Is it the place where the platform is located? Does it change whether it's goods or services? What's a good, what's a service? Problems of definition. So there may be a starting point, and again, this is just one option the Commission is looking at, to perhaps think about introducing a deemed supplier model, but initially in a very narrowly focused way. Bit like Canada in relation to things like transport, passenger transport, and accommodation services. Let me now hand over to Stefan. We've had quite a few questions coming in. So Stefan, where are we on the questions?
Well, we've received a few questions through the chat box, so which you can respond to directly. And we've also received a few questions through the Q&A box. I've noted some of them down. So the first one is, when it comes to distance sales from Northern Ireland to the EU, do traders account for VAT using the import one-stop shop? Maybe you can take that one, Luigi?
Yeah, sure. So one thing that we need to bear in mind is that Northern Ireland is still effectively part of the EU for VAT purposes. So traders in Northern Ireland can still join the union scheme, which is of course a real simplification compared to what traders in the rest of the UK need to go through. So Northern Irish traders can join the union scheme, and traders based in Scotland, Wales, and England have to join the import one-stop shop.
Okay. A second question that came in, and coincidentally also related to Northern Ireland. What are the thresholds that suppliers based in Northern Ireland need to bear in mind?
Now, when it comes to UK supplies, Northern Irish businesses can still take advantage of the rather generous, rather high VAT registration threshold of £85,000, meaning that if their UK income is below those limits, they will not have an obligation to register for VAT in the United Kingdom. But there are a couple of funny things to consider. So bearing in mind that Northern Irish businesses can take advantage of the union scheme, this allows businesses to use their home country rates and rules for distance sales when these are below 10,000 euros, which over here in the UK is 8,800 and I think 8,818 pounds. And these are sales to the whole of the EU as opposed to sales to individual countries. But the trader needs to be registered for VAT in its own country in order to take advantage of the one-stop shop. So HMRC has announced a few months ago that it basically allows Northern Irish traders to register for UK VAT, but not account for any output tax in the UK if they are below the UK registration threshold of £85,000, which I guess is a practical and pragmatic approach, but it's also, of course, a strange position to be in. But there are a few strange things going on with Northern Ireland, and any Northern Irish suppliers will probably wish to consult with my colleague Colleen Flanagan, who is our #1 expert on all matters involving the Northern Ireland protocol and indirect taxes there.
Yeah. Okay, thank you, Luigi. Another one that came in through the Q&A box, it's almost like a small business case. It says, I have a client who is established in France with a permanent establishment for VAT purposes in Belgium. The business is considering having small amounts of distance sales from both France and Belgium to non-taxable persons residing in various EU member states. Does the threshold of 10,000 euro for micro businesses apply to this client? Ibrahim, maybe you can take this one.
Yeah, sure. Thank you. A very good question indeed. In short, the answer is no. The threshold for micro businesses only applies to suppliers established in one member state. And to mitigate its VAT burden, the French business may choose to use the Union OSS scheme in France to declare its distance sales from both France and Belgium in its OSS return.
Okay, thank you, Ibrahim. I can see that a last-minute question came in through the chat box. What do you believe will be the impact on e-commerce of the EU-COM proposal on VAT rates? Stephen, have you got any information on that, maybe from the Commission or?
Well, I think the answer, if you like, unfortunately, is it's going to give member states even more freedom to set their own VAT rates. So consequence of which, I think the Commission estimates that across the EU, we already have, I think, around 60 different VAT rates within the EU. With the proposals on the table on VAT rates, which the Commission hopes to have adopted, or rather to persuade the Council to adopt the directive before the end of this year, so before the end of this month, it would, of course, just mean that member states would have, in principle, greater flexibility to fix their own VAT rates. So we could actually end up with even more VAT rates than we have currently, which means from a systems perspective and a compliance perspective, it's going to, I think, make life even more difficult for businesses operating across borders.
Okay, great. Thank you, Stephen. So I think all of the questions that were raised either through the chat box or the Q&A box have been answered now. So this concludes our Q&A session for today's webinar. Thank you for the questions sent through. Before we end today's session, we would like to draw your attention to some of the free tax resources which we have available. You can access these by visiting our PKF International website at www.pkf.com. On our website, you will be able to locate the closest PKF firm within your city for assistance with any indirect tax challenges you might be facing. For your convenience, you can search by country, city, keywords, or use our world map as a search for by region. On behalf of today's panel, I would first like to thank all of you for joining us today globally. I would also like to thank all of the presenters for their hard work. The third session of our Global Indirect Taxes series, Cross-Border Services Navigating Local Requirements, will be hosted on the 2nd of February 2022. You can register for this event through our website pkf.com or email events@pkf.com. That is events@pkf.com for the registration information. Also keep an eye on PKF International social media pages on LinkedIn, Facebook, and Twitter for the registration information of these upcoming events. In the meantime, be well and stay safe, and we hope to see you in our next PKF virtual event.